Hi, Leeb viewers. Today's Monday, October 26th. I'm Greg Dorsey. Well, it was another ugly day in the markets on the heel of what was an ugly week last week for equities and bonds. Nothing really to point to news-wise, pushing stocks down and investors to the sidelines today, with the exception of the dollar, which rallied fairly strongly. As we've been saying, while the dollar's long-term direction is down, the bear trade has gotten pretty crowded here, so it's not surprising that we're seeing some sort of counter-trend rally. There are plenty of things to point to as a cause for concern in the overall stock market. The technical action last week was by far the worst we've seen in quite a long time. I won't go into great detail, but I do want to touch on a couple of points quickly. Smaller shares trailed the Dow Industrials by a very wide margin. The Russell 2000 small cap index, for instance, was down about 2.5%, while the Dow Industrials fell just 0.24%. We have a lot of stocks hitting new highs. About 22% of the NYSE stocks are hitting new 52-week highs these days. But don't mistake that for a sign of better things to come. Given the route stocks have taken over the past year, the sharp sell-off and the sharp run-up since March, it's really not surprising to see we're seeing those kind of numbers. But again, that's not necessarily a bullish thing. If you're going to look at one chart these days, take a glance at the Dow Transports, which, after failing to rally above their mid-September highs, look to have traced out a double top here. Typically, that sort of double top formation presages a decline in the broad market. Also interesting from a technical perspective, this past Friday, the SPY, the S&P 500 Depository Receipts, the ETF for the S&P, filled a gap in its price chart dating back to October 10th of last year. If there's one thing you can count on when it comes to reading chart patterns, it's that gaps get filled. And in this case, stocks reverse direction. In this case, stocks should be heading south after that. Switching gears, today we saw selling in commodities as well. Most notable of these was gold, which broke support around $10.50 or so an ounce. Frankly, we would have thought that it would have broken down a little sooner, but we don't make too much of this. From a long-term perspective, we think the bull market is still in place. Shorter term, though, the metal could trade down probably to 1018, 1020, that area, before finding good support. Use any such decline for your available cash to buy gold and gold shares. As again, I can't pound the table hard enough for this. We think that really is the best area to be in looking out over the next couple of years. Well, that's all for now. Thanks for stopping by, and we'll see you again soon.